We're proud to have this episode sponsored by ShakePay, the easiest way for Canadians to buy and earn Bitcoin. I love using ShakePay because it's fast, it's easy, the app is great, and it doesn't hurt that they give away free sats, which is free Bitcoin, every day just for shaking your phone. They also have the ShakePay prepaid Visa card issued by People's Trust that earns you up to 2% cash back in Bitcoin. Not points you have to redeem, just Bitcoin added to your account automatically. Like I said, ShakePay really is the easiest way for Canadians to buy and earn Bitcoin. So join the over 1 million Canadians already on ShakePay. Sign up is fast and free. It's so easy, a boomer can do it. Plus, sign up for ShakePay with the promo code Loonie Hour, and you'll receive $10 after you buy your first $100 worth of Bitcoin. That's promo code Loonie Hour. Thank you, ShakePay. Now back to the show. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 69. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management, and we got Rich Diaz of Acorn Macro Consulting. Rich, what you're in a cabin in the woods, or what's going on?
Auf Wiedersehen. No, I'm in Austria. I'm in St. Anton, which is an absolutely magical ski resort / booze fest for middle-aged European men. I'm here with a bunch of friends of mine. Icelandic buddy Fritz, he invited me out. So it's me and half a dozen of the largest people you've ever seen. And we're skiing every day, all day, and drinking way too much beer. But if you're Canadian, you've never gone out to Europe to ski, it is an enlightening and life-changing experience. It is way better. The food's better. It's cheaper, believe it or not. The hills are better. The girls, who knows? Like, I'll let y'all leave that up to you. But
bit of a sausage fest. That's the
it is
word
a
on the
sausage fest,
street.
but skiing out here is an enlightened and refined experience, and I would recommend it to everybody. What about you, Keith?
Actually, it sounds pretty good, other than the ratio there. But Keith, what's going on, buddy?
Yeah, well, one of my best friends when I was offshore, this Irish guy, they went to St. Anton every year for ski holiday. And like Rich said, I've never been there, but I think the reputation is well deserved. It's supposed to be a lot of fun. Yeah, that's good, Rich. That's good.
Yeah. And I'm still in one piece.
It looks cozy.
I have one more day of skiing tomorrow, so stay tuned.
Well, we got a busy episode this week. We got a guest, a popular guest on the Canadian Twitter sphere. Ron Butler of Butler Mortgages. So we'll be bringing him on into the show very, very shortly. But I think there's a lot for us to get into this week, ahead of Ron's commentary. But, we got some insights from the Bank of Canada last week, which we, went in depth on this episode, where basically the Bank of Canada essentially came out and says, hey, listen, guys, here's 25 basis points, and we're going to pause and we're going to wait and see, moving forward on how the data progresses. So, the first central bank in the G7 to hit the pause button. And then, of course, we had a slew of central bankers this week. So we had the Fed out this week. We had the Bank of England, and, of course, the ECB, the Economic Fantasy Land, all coming out with their rate hike announcements. So, Keith, I don't know if you want to start things off with the Fed, sort of your reaction to the Fed raising 25 basis points, which was expected. But I think more importantly was the presser from Jay Powell afterwards.
Yeah, it was. I think, I've been a big fan of the Fed, in the cool world of nerds. If you're a fan of a central banker, where you rank up there. But it was pretty disappointing. And a lot of the guys I know as well, like they were extremely, I don't know, it's confused. He just did not do what he's been saying he was going to do. So he basically rolled over and, he left the door open to do stuff. They didn't say, hey, we're finished, like the Bank of Canada did. But it was a bit of a dovish presser at the end. So, and Rich is going to show us some of the data, which is supportive of that. But the big I mean, the big analogy or the big story now with the Fed, they have this opportunity. It's like it's a central banker's dream. There's no risk ever. Things are under control, and then boom, inflation comes out crazy. Now is your chance to shine. And the only other period they had to compare this to, was back in the late 70s and early 80s. And it was a story of two central bankers then. So one was Burns. What's Burns?
Arthur Burns.
Yeah.
Arthur Burns.
And for political reasons, he wasn't able to do what he wanted to do. He wasn't able to raise rates aggressively and just try to just stamp it out. And then Volcker came along, and he did have the political support to do it. But then he wimped out after the first attempt because he cut rates after the recession came along. And then he came back aggressive. And so this is one thing that Powell has talked about several times. They have that period to compare to. And so he was being, placed on the same side as Volcker, except he wasn't going to make the Volcker mistake. But after yesterday, now people are comparing him to Burns. So in the world of, central bank land, it's, you've gone from, having a good time at St. Anton doing stuff to, being the cool kid on the block. And now you're, at the smallest hill over in Prince Edward Island. There is a hill on PEI. Have you ever been there?
Me, no. I'd love to. I want to go on the bridge. I want to go on the,
there's
the Confederation Bridge.
Yeah, that's a good bit of fun. There's a ski hill there as well. But anyway, the Fed announcement, the market reaction was saying, hey, risk full on. And then for the sake of time here, if we compare that now to what the Canadians did and then what the Europeans did this morning, and the same with the Brits, everything is now set up for the big pause coming up. So it's, it seems like it's party on. It's St. Anton on in the central bank world, Rich.
Come on.
I mean, we'll definitely expand on that. But I think it was interesting, actually. The Fed actually called out the Bank of Canada because they asked, would you consider, I guess, pausing and then sort of reassessing and then maybe hiking again? And so the Fed's like, well, no, we're not going to do, what the Bank of Canada has alluded to, what they're going to do, which is, they've officially paused and we'll sort of reassess. But Keith, was your interpretation of the whole speech there? Basically, it was I wouldn't call it a pivot, but really quite a dovish sort of speech there.
No, because if again, you hear what you want to hear.
Yeah,
that's what I was going to say.
And you want to hear, like, and again, you go back to the Jackson Hole when he came out, he was pissed off. He talked for 40 seconds and dropped the mic and left. Right, that's what it was. And it was, very passive the way he was talking yesterday. I mean, that's where we are now, right? So that's what we have to deal with. So now the conversation is next going to roll over to, is the recession? Because the other thing that the Fed did yesterday, they were somewhat taking a victory lap, similar to what the Canadians did last week. So he was saying, yeah, we in our scenario where we're looking right now, we think we've achieved this. Inflation's going to come down. We'll maintain, strong employment and all that stuff. So it's if you listen to them all, and the fact that he did mention Bank of Canada, they talk to each other all the time. They do. They're largely using the same playbook. This morning I was mapping out, the rate increases by the ECB and the BOE and then the Canadian. Like it's all going in the same direction, which of course leads to this concept that I call, or I refer to all the time, is that risk has been synchronized. So we're either going to get this real incredible, nice, soft landing, everything is awesome, or something's going to get screwed up here and we'll be, have a real quick round trip.
Rich, what are your thoughts? Because it definitely feels like, sticking to the Fed and the BOC here for a minute, but definitely feels like people, or markets anyways, are pricing in sort of the ongoing narrative, which is the soft landing. And it seems like there's hope that we can achieve that. And so, the people are sort of writing this fairy tale ending. I don't know how you're looking at things these days, but just kind of curious your thoughts on obviously the big announcement.
Sure. I mean, so just to give people sort of some context, we're, what I think the Fed's at 4.75. The Bank of England moved 50 basis points up to 4, and the ECB did the same. I think is at 2.5 now. Both the ECB said, they're not done. The BOE was more sanguine. I think this all sort of boils down to the fact that people are taking a victory lap on inflation. And I think this is where I think I'm going to start to push back harder and harder. I think when I say everyone, I think the market seems convinced that the inflation is like no longer a problem. It's in the rearview mirror. And this is where I think that's where a lot of this sort of, the expectations of cuts, expectations of the pauses, whether it's in the Bank of Canada or in the Fed, are coming from. I think that's where it's derived. There's worries about the, economic activity. I get that. We'll talk about the ISM a little bit later, but ultimately I think that's it. And maybe this is not the right week to talk about sort of my prognostications on inflation and why I just think it could surprise people. It could surprise people to the upside. I think over the next little while, I think right when everyone's sort of convinced it's done, I think if you dig a little deeper, I think you can really make a case that is not at all done. But anyway, but as far as like what's doing well, I think we have to be really skeptical, I think, of the leaders coming out of the year. So the leaders are basically all the stuff that sucked last year. And I'm not to say that you shouldn't own these things, because I saw some Spotify's up 30-40% or whatever. Meta,
Bitcoin, Keith.
Bitcoin's the best performing asset on the ones that I cover. I think it's up 43% year to date. But it's just I think I'm always just a little bit skeptical whenever you see like all the losers from last year or all the winners from this year. And it's sort of related to this long duration, lower interest rates, lower financial conditions. It's all sort of still related, right? It's tech, communication services, and consumer discretionary. That's all up. In a world where it's just, it's that same long duration bond trade, basically, as we've discussed many times.
I think I saw that in the Globe and Mail today as well. Yeah.
Oh, I don't read the Globe and Mail.
Damn it, Rich. Yeah, to your
the joke.
to your point there, we've talked a lot about the inflation. I'm personally a bit of a disinflationist, I suppose. But I do worry, to your point, that has inflation really been killed? Does it come back? And to Keith's point earlier, right? The Arthur Burns Volcker situation, central banks politically will ease the first time around, and then for inflation to come rip roaring back. Is that inflation comes ripping back sometime in 2024 and we're back to sort of square one? That seems like a very decent probability. And what's interesting as we bring on Ron Butler here in just a minute, you see the equity markets going up, you get this wealth effect from that. There was actually an interesting paper that was put out, an academic paper that was brought in through the Fed there. It says that the wave of early retirements in the US was due to boomers experiencing huge home price appreciation. So thus they felt wealthy enough to not work anymore. So, if we do have this hypothetical bottom in the housing market and in the equity markets, I think that certainly makes the inflation fight a little bit more challenging.
There's also there's one more thing on the inflation thing, and not to just to really hammer it home quickly before we introduce our guest. But it's just everybody talks about these contributions. So you had these massive upswings, in particular contributions to new, I think it was used cars, or, all these sort of esoteric, tiny, outsized, massive contributors. And what everyone's taking victory laps because used cars are down 10%. But what they don't quite figure out, though, is that contribution is not going to go from plus 3% or 2% or whatever to negative. It just goes back to its long-term average of contribution, that is to say 0. So if it's not going to drag on inflation, it's just going to stop lifting it up. And so when you consider the services components based on wages and strong labor market, we can argue about the validity of the labor market a little later, but it'll be interesting to see how this plays out. And then you look at stuff like copper, and usually that's a really good lead, and all of a sudden you're starting to see that, and on other industrial metals. I think it'll be fascinating to see. It'll really throw people offside if the rest of the year is one where everyone who was, taking a victory lap on inflation is proven wrong, including the Fed and our boy Tiff. But
so speaking of victory laps, we got some victory laps happening right now in the housing market from some people in the industry. Certainly not from our boy Ron Butler, but let's bring Ron in right now.
I'm here. Here I am.
Made it. Thanks for coming on to the show. We are a highly anticipated, the first inaugural guest of the Loonie Hour show. How does it feel?
Honor. It's an honor. Thank you.
Yeah, no, so we were just talking before you got on the show here. We're talking about, the central bank. I don't know if I'm going to call it a pivot, but the pause. People are now optimistic. Markets are all excited. Equity markets obviously taking off. And there's a lot of optimism these days in the housing market in Canada. Of course, people, I think, maybe getting a little prematurely excited about, the resurgence of some houses coming back into multiple offers, open houses being busier. Have we reached the bottom of the Canadian housing market already? I'm kind of curious your thoughts. There's a lot to unpack there. We won't hold you to any forecasts, obviously, but.
Well, premature anything is generally frowned upon. That's not the best. That's not the best option for sure. Look, it's like this. I mean, the last 3 months, the last quarter of 2022 was about as appalling as it could possibly be for real estate in Canada. We're looking at 24-year lows in sales activity. So there's a degree of pent-up demand. We see some fixed rates below 5. That's interesting to some people. And, we've got a flurry going on right now. I think that we'll see that it's not going to be a great year. It's not going to suddenly revive and jump up to being similar to 2020 or the ridiculous year of 2021. It will be just a not good year in Canadian real estate this year. As far as the Bank of Canada is concerned, my thoughts on it are that the Bank of Canada governor is probably tired of looking like an idiot. And, he's wrong on inflation, wrong on low rates for long, got an opposition leader who wants to fire him, like stating it openly. Yeah, that guy's got to go. So I got a feeling he's tired of being wrong, and there will be no rate increase in March. It just won't happen, barring some kind of insane jump in inflation or the continuation of the phony Canadian jobs report. But this time we're going to jump into 250,000 or something ridiculous. Outside of crazy outliers, no, there will be no increase in March. So that's what will happen.
Keith, we had a big revision there, where the 400,000 revision, I think, to the jobs numbers in Canada. So the random number generator strikes again.
I remember we were talking about that when it came out a few weeks ago. Hey, Ron. So first of all, I guess Steve didn't tell you, this is a casual day show when we do it. So I do appreciate the shirt and tie, but next time
this is my casual appearance every day. This is how I appear every day. This is me. This is my version of a 49ers game jersey. This is it.
I like that. I like that. Why don't you share with us? I don't know I know this much of everything. So share with us, though, like on your desk, are you seeing some certain institutions being more aggressive to get market share now, or has everyone retracted at the same time? Like, are you seeing I don't want you to share with us who the dominant player is or anything, but are you noticed anything that would lead you to think, based on what you've experienced before, to say, hey, these guys have always been more right than wrong, or more wrong than right, to give you a little bit of more clarity on where, the market might go in the next few quarters?
Well, as far as the Canadian banks are concerned, they're all going to have fairly lousy quarters for the next couple of quarters. I mean, that just is what it is. Their mortgage origination volume's way down. Some of them, not all, but some of them have persistent NIMS problems that aren't going away. And just was talking to a couple of them actually last week. The NIMS problems aren't going away, and there's no ability to crank up volume, and the quarters that are gone already. They're lost. So the pipeline for the next quarter is bad. So it's going to be a bunch of poor residential. In the banking world, you call it RESL, you call it real estate secured lending. And it's going to be a lot of lousy RESL results in terms of origination. So that's just going to be 2 lousy quarters. There's no question.
What What about provisioning for loan losses? Like, have you had that conversation with them? Because if you go back, say over the last decade and use, one of the blue shirt banks as an example, the numbers, what they have allocated today, it's really in line with what they've had over the last 10 years. So one of the thoughts that we have with this is that we know the economic cycle today is nowhere close to being the same at any point over the last 10 years. Yet their dollar amount of provisioning, it's not out of whack, but their mortgages that they've been originating, what's left on their books, has to be more than what it was in the past. So in my mind, with the banks, if there's any surprise coming up, is that they do have to play, a rapid catch up on that side of their income statement. Are you hearing anything like that from them? Any concern, or is it just, hey, it's a soft landing, nothing to worry about?
It's 90-day default numbers in Canada that went from 14 beeps to 15 beeps, which is still, if you talk to bankers in the United States, they just tell you that's indicative of you being way too conservative. If you're not running 35 beeps 90-day default, there's something wrong with you. So it's great numbers, but it's going to erode. It's going to erode very gradually. It's probably going to get past 35. There's going to be additional provisioning in a gradual way. Because there's one thing that's sort of changed a lot since over the last 10 years, particularly. The Canadian banks offload, not intentionally, but just by default, have offloaded a ton of mortgages to alternative lenders. The private mortgage industry, the mix, the mortgage investment corporations, the growth in that industry over the last 10 years has been phenomenal. So they've taken a lot of the really problematic business, or the marginal business, or the things that the bank might have thought about at one time but just didn't do. And they've provided those companies and those organizations, those even private lending individuals, have really become a segment of the marketplace that wasn't the same 10 or 15 years ago. So a lot of the truly problematic loans or the marginal loans are not even on the bank's books. They're somewhere else. And that's why when we see in the Ontario region, when we see power of sale, that's our version of what we call foreclosure here, when we see that go up, the names beside the people selling the houses are rarely ever banks right now. They are some sort of private lending operation. So that's indicative of something. And I think that it's just a case of the banks are not that exposed yet. They will be eventually, but not right now.
Ron, do you think that that inherently makes the overall system or the market maybe more vulnerable or risky, that you've got more and more market share going towards, private lenders, mix of that nature? What's your kind of take on that?
Well, once their losses on properties burn them down, they're going to be much less a concern because they're not going to exist. They're going to be insolvent. But it's a great thing for the Canadian banks. I mean, when you listen to Peter Rutledge, the bank regulator, talk about even further tightening of mortgage rules, I believe that some of his thoughts are, we have a facility available to take up the slack anyway. And it's a facility in the private mortgage world, in the MIC world, which I don't have to regulate. So I'm happy to offload more lending to those organizations. I mean, that's a back of the mind idea, but what he's observed is during the great run up and the astronomical amount of mortgage origination that took place in 2021, when you audit those files, they're pretty good files. They have the possible problem of having too many cosigners. Like it was the 2021 was the biggest year of more than 2 applicants on a mortgage application in the history of the country. So there's just a lot of people who co-signed. But I think definitely we're going to see an increase in delinquency, an increase in default, but it's not going to be, in my judgment, it's not going to be something that's going to be unmanageable for these 5 untouchable banks.
So I have a question.
Can I jump in?
Rich, go ahead.
So first of all, hi Ron. Thanks for joining us today. I'm a big fan. I've been following you in a long time on Twitter, and I really appreciate the content you give out for free, even though
Thanks.
sometimes I don't understand it. The tone you're striking is one of someone who's quite sanguine on the possibility of a structural and prolonged down leg in, let's call it, one of, if not the most overvalued housing markets in the world. And the way I would describe that is sort of the regular stuff of house price per income, house price to rent ratios, and then comparing things like residential investment relative to GDP or overall investment. And then comparing those cross country and across time. And whether you have those bubble type numbers, again, it's a little bit difficult to describe a bubble when you're in it, but whether it's Ireland, Spain, Japan, or the US, it always ends in tears. And the way that you've sort of outlined it, maybe I've mischaracterized it, is something that you have sort of a soft landing, forgive the expression, in that market. Is there something that I'm missing for someone who's sort of a top-down guy and maybe doesn't spend as much time on Canada?
Well, Ireland has 8 million citizens. It's a tiny country. Spain was entirely a promotion of a vacation home building. The United States was a scenario where every single bank-generated mortgage product was garbage. I mean, there was you had Chase, you had Chase issuing paper, what they considered AAA, where the average when the minimum FICO score was 525. So, if you study the 2008 USA disaster, you discover that it was effectively an underwriting disaster. It was a crazy disconnect of banks finding a way to offload hellacious loans to other parties, and the amount of ninja loans just grew beyond the capacity of the marketplace to handle it. So there are some fundamental differences between all of those scenarios you just described. What happened? What's different about Canada? Hey, I agree with everything you said. The average income to average house price ratio is batshit crazy. It doesn't make any sense. The overall prices of homes in Canada, almost right across Canada. I mean, why the hell would you have the price of homes in Moncton, New Brunswick go up 35-40% in 1 year? It's absolutely crazy. It's all wrong. Everything you described is true. But we have some unique things going on in Canada. We import more people to this country every year than any other G7 country by a long shot, by in some cases, by a geometric increase. So, we have some underlying structures here. We don't build enough.
Ron, one second, Ron.
Yeah.
You used the word geometric. Now you're trumping Rich. You usually calls about the diffusion index, which causes everyone to sort of go off sides. So I think Ron could be a regular, member of the Loonie Hour for using that. I love geometric data, by the way.
Well, when you have some countries that have zero immigration, and you have Canada, it's almost geometric. Yeah.
Hey, so Ron, just to you alluded earlier to our buddy here, Peter Rutledge at OSFI. So he's come out and made some proposals that they're sort of discussing, I guess, internally. They're doing some reviews, and they've talked obviously about more credit tightening. Do you have any sort of update on that? Any inklings that you're able or willing to share today in terms of how you think that might go?
There's no update. There's no inklings. They're going to talk to probably like 150 stakeholders and only listen to the people at the big five banks' opinions. And they're going to come out with a bit more tough guidelines. Rutledge, his background at National Bank, he was as you pointed out, he's the author of a report that he thought that 33% of all the investment properties in the Vancouver area were owned by offshore, were funded through offshore money. So he has an affinity for, the fact that there is a bizarre level of investment amongst Canadians and a desire to have investment property. And in the back of his mind, and not just Canadians, but others and in the back of his mind, he says to himself, let me put it this way. 2.5 years ago, the regulator floated a balloon that, hey, I don't think that it's a good idea that people take a HELOC, a home equity line of credit on their house, extract 20% down payment, and then go out and buy a rental property, get a mortgage on that at a variable rate. We think that's probably a bad idea and we should ban that. And then for whatever political reason, that went away. That just died a quiet death. But I think he wants to revisit the idea that there has to be a better relationship between the totality of lending that the individual has in a mortgage and what their income is. Like that seems to be the clear message that's coming.
That seems like terrifyingly obvious to anybody with a brain cell.
Terrifyingly obvious. Yes, terrifyingly obvious. That's correct. Yeah.
But yeah, I mean the idea though of borrowing on the HELOC to buy a secondary investment property obviously looks pretty compelling when the rates are at 1.5%.
And the HELOC is 295. Yeah, exactly.
Yeah. Much less so today, obviously, with your what's your HELOC at today? 7.2. 7.2. Yeah.
So it's also an indictment on Canada's productivity growth, which we have none, and the fact that we don't invest in anything outside of residential investment, right? Gross fixed capital formation is 45% resi. Compare that with the US, which is less than 20. So it's just an interesting comparison. But
you'll never hear me fight the idea that our pricing doesn't make sense. Our relationship of average income to house price doesn't make sense. The level of individual debt and versus, none of those things make sense in this country. They don't make any sense in Australia. They don't make any sense in New Zealand, which are, by the way, are all other countries where there is a massive amount of foreign capital that comes in to buy real estate every year and has historically for a long time. But set all that aside, the reason I'm not calling for some kind of mortgage and real estate apocalypse in Canada is that a lot of the bank mortgages are reasonably well underwritten. Some of the experience of deep price discounting, deep price fall is in very specific areas. And when you start to dig into who financed some of those ridiculous run-ups, so we go to, in Vancouver, the Vancouver area, Lower Mainland, you can go out into the Fraser Valley and go out to a little town called Chilliwack. It's the name of a rock band too. But anyway, the prices were increased about 50% in 1 year in that locality. And people were buying those houses. They've now retraced by about 35 or 40%. Same thing here in Ontario. There's a suburb called Uxbridge. That's retraced 35%. Old town called Oshawa, that's retraced 35%, 35%. So we have these regional retracements in prices that are going on, but it's all not the power of sale action in those areas, which exists. People are taking, and some people are just plain taking the loss. They're just taking the loss. They lose all the money from the sale of their previous home and flee. But there is power of sale activity in those areas. And if you look, again, you look at the people who hold those loans, they're not typically the big five banks.
Hey, Ron,
can I ask you one more question? Go ahead. Sorry.
Whoa. That example you just gave, Uxbridge, what did you call that town?
Uxbridge.
Okay. So you said people are just selling, taking their loss. Why are they selling? Is it because it's an investment property?
Well, they had a variable rate mortgage, and they bought a house. They bought a townhome for 1.4 million. That's now retraced to $1 million, and they had a variable rate mortgage that they can't pay the mortgage anymore. But they sold a house, and they had a $600,000 down payment because they sold a house during the big run up to buy the next property, or they sold a condo they made some big money on. They sold something to get into that home, or they got gifted money from their parents, whatever the case may be. And they have, they just bought at the worst possible time, had a variable rate. The payments are completely unmanageable, and they're just going to take their lumps. They're going to, maybe if they have a shortfall at closing of 50,000, they're going to go back to the bank of mom and dad, get that money, get out from under. It's a tragic financial loss. This is like a life altering for the average person, average couple. That's kind of a life altering loss. But we saw one close just the other day. It was a loss of $450,000.
I just have one more question. I know Rich has one as well. Talk about, because I see what you have on Twitter, recently, and I'm sensing there's more enthusiasm today than it was, in Q4 and Q3 and stuff.
Definitely.
Yeah. What's driving the enthusiasm? What's different for people today than it was 3-6 months ago? Is this just simply price, or has something changed with their specific household income, or was it year-end bonuses or something?
So what it was, it generally falls under the rubric of fed up with waiting. Now, these purchases tend to be under $1 million. Some of them are under 700,000. They are people who've been looking at real estate for a year and a half. They've noticed that in many cases, the multiple bids have gone away. rates have fallen. If you go back to Q3 and Q4 last year, most mortgage rates had a 5 in front of them. Now it's not too hard to get a mortgage with a 4 in front of it. And just that sort of minor affordability change, and just fed up with waiting. And okay, now there's, this is a condo I like. This is a condo I like. I had this conversation with a client just last week. I said, "You're buying now? I thought you were going to wait till the spring or the summer." He says, "I just got fed up. I just got fed up, and I found a condo I liked, and there was no multiple bids, and I just decided to buy."
It's interesting because we're seeing it across our network as well, because we know a lot of people that they've been waiting on their sideline, and all of a sudden, and now it's starting to percolate a little bit. Rich, what did you have? Because I know I sort of jumped in front of you there a few minutes ago.
No, it's all good. So my question was related to your question, which is why people might sell, but it's sort of the next sort of looking ahead a little bit. I mean, we've talked a lot about the great rate reset, right? There's countries like Australia that has 90% of their mortgages are variable. You mentioned New Zealand, which is a similar situation. Canada, we have fixed rate mortgages, but that's a misnomer completely. 2 years is not fixed or anything, or 5 years even. Compared that obviously with the US, where it's a 30-year fixed rate mortgage. Have we made too much of it as far as the expectations that over the next, 2 or 3 years that people are going to get totally sidelined by these much, much higher mortgage payments? And
can I add to that as well, Ron? Because
Sure.
That's actually leading to my question as well, which was, because like a lot of the narratives, at least you go on Twitter, a lot of the narrative was, well, you're going to see a flood of listings. People can no longer afford their homes. Rates are up obviously significantly. So do you to add on to Rich's question, do you foresee sort of a wave of new, because one of the challenges that we're dealing with in the housing market right now in Vancouver and Toronto, when you look at the data, is like new listings are running at like 20-year lows, which is obviously supporting the prices, at least in the near term. So I'm kind of curious if in your opinion, anyways, where that might lead.
Sure. I'll start by answering that like this. When you talk to every chief risk officer at every bank and ask them what their concerns are about mortgage default, they say there's 3 keys: employment, employment, and employment. Okay. So at this moment in time, we don't have major employment. I lived in Alberta when there was something called jingle mail, that people would take their keys, and banks used to have this big box you could pull open and drop it's designed to drop deposits into in the middle of the night. When you ran a store or something, you closed up, you'd drop. Well, people started dropping their keys into it with a note that says, "Yeah, I've left, I've moved away, take my house." I mean, that's because they had no jobs. They lost their jobs. There were no jobs. And it was going back to more or less the Bronze Age, when Pierre Elliott Trudeau had something called the National Energy Policy. So, there have been those experiences, but we don't have any kind of employment problem in the major real estate markets of the Lower Mainland or on Southern Ontario or in Montreal right now. We don't have any kind of significant unemployment issues. That may change, and that change is the change. If you can say, well, a year from now there's going to be a severe recession and a big unemployment problem, or 6 months from now there's going to be a really bad recession and a big unemployment problem, then all of a sudden you are going to see some listings. You are going to see some mayhem in the marketplaces. But again, if you talk to any risk officers at major financial institutions, they say, we think rates traditionally do not cause, except in specific situations, like the people who are leveraged, people who have 3 homes and too much HELOC and too much variable rate. But the person with 1 home and a variable rate, they're probably going to find a way. They're going to find a way to get through it. Or they may just want to wait till the spring. We may see more inventory of listings in the spring, but it's employment. In the mortgage business, in the default mortgage business, employment is the key.
Good point. I think, Keith, do you have one more question? Because I got one more and then we'll let Ron go.
Yeah, I had just one more. I'm just, the whole time I'm listening to you and I'm looking at the paintings or the pictures behind you on the wall for people. Now I'm wondering if that is somehow a symbolic of homeowners or people with multiple homes, what's happening these days. So people can't see
actually,
it.
The name of one of the paintings is the Butler singing, so that might have something to do with it. So.
Maybe so. What do you have there, Steve?
Yeah, just to kind of wrap it up, it actually comes back to, I guess, the initial part of our dialogue there. Ron, you mentioned your some conversations with people at the banks, and some discussions around NIMs, net interest margins, some issues there. And I think we had chatted about it on Twitter not too long ago, where kind of curious what your view or outlook is on mortgage rates, because one of the things we've chatted about is, if you look at where the Canada 5-year bond yield is today, which historically prices your 5-year fixed mortgage rate. So your Canada 5-year today is at about 2.9%. Historically, that's a level that suggests that your 5-year fixed mortgage should be in the low 4s. Today, obviously, I'm sure you'll be able to tell everybody that your 5-year mortgage, if you're lucky, might be able to get it at 4.8, give or take. So, do you foresee those net interest margins starting to sort of figure themselves out and fixed rates to come back down, or are banks just being a little bit more conservative right now and rates are going to stay kind of where they are despite what's happening in the bond market?
Well, there's a credit swap and a general liquidity component that has to do with these rates. When you were seeing those rates that were generally produced low 4s, liquidity was infinite in the Canadian marketplace. It just is not the same way today. I mean, there's all kinds of factors that lead us to that. But yeah, by the way, if you want to buy a house for under $1 million and only put 10% down, I can get you a 4.29 5-year fixed rate. So there are some low 5-year fixed rates in the market.
God bless CMHC.
But yeah, you have to talk to CMHC. About $40,000 in insurance premium too. So be prepared. It's big money. The bottom line is that there's just not as much liquidity in the market. The credit swaps aren't where they're at. But will 5-year and 3-year fixed rates, even 2-year, grind down? In all probability, yes. One of the big questions we have to ask ourselves, though, is, are we going to ever see a rate with a 1 or a 2 in front of it in the near future? Well, I'm 65 and really fat, so the chances of me seeing it in my lifetime are low, in my opinion. I mean, I don't think we're going to see rates with a 1 or a 2 in front of it for a long time again. And that will be a kind of a drag on the whole Canadian real estate market. Rates in the mid 3s to low 4s. The average pricing in some of our provinces, it's very hard to have a buoyant real estate market with those kind of rates. It's just hard. It doesn't mean that it'll just dry up, but it means it's going to be a lot tougher in the coming years, because I don't think we're going to see a rate with a 1 in front, mortgage rate with a 1 in front of it or 2 in front of it for quite a while.
Yeah, no, I mean, I would agree.
Yeah. Do you mean like 11 or 12% or 20%? Is that the direction?
No, I mean that in late 2020 and part of 2021, we were handing out 5-year fixed rates for 1.59 to 1.79%. So that creates a very buoyant housing market.
That makes more
I'm
sense.
shocked that the rates went up at all.
opposite.
I'm shocked the rates went up at all. We were told they were going to stay very low for a very, very long time.
There's not two varies, but there is one vary. There was one vary. The rates
stand corrected
for a long time. So,
Rich is somewhat British, so he likes to, really be.
You got to recall, inflation was only transitory for a long time. Just a long time. We heard that. Very long.
That's
time.
right. That's right.
Now we've got it figured out, and the bull market's back on, baby. No, we'll see, Ron. Really appreciate your time and your insights. Just for sharing, and always a very, very good, balanced, humble view of the markets. So really appreciate that, and I'm sure we'd love to have you back on.
Absolute pleasure. Thanks very much, guys.
Take care, Ron.
Take care.
Well, Ron was lived up to the hype for the first.
How do you feel, man? Like, we've been having our after school special hangout for over a year now, and then you bring a new kid on. I'm not quite sure. How do you feel about that? That was fun though. That
spiced it up. It keeps you on your toes, I think. But I mean, there's I could have kept going and just I had so many more questions. So
we'll save it for next time. Hopefully he'll join us again.
Yeah, great follow on Twitter. You look him up on Twitter there. I don't have his handle in front of me, but Yeah, I mean, I think that kind of, paints the picture of what we're seeing in the housing market. Just a quick update on sort of some of the Vancouver numbers here, and even in Toronto. So Vancouver, we had the fewest home sales for January since 2009, and the fewest number of new listings since 2004. So I initially put out a 25-year, but it was some of the data came through a bit late. So, but yeah, lowest listings. So
Steve,
since 04.
can that be adjusted for like the amount of inventory, for example?
No, it's not. That's just like this, that's the raw figure. So that's not like seasonally adjusted or adjusted for population, or like, this is just the raw number. So when you factor
So it
in,
has to be even worse than, what I think, was it 09 that you compared it to, or 08? What was the
so fewest home sales since 2009.
Since 2009, yeah.
Yeah. So the January
there
09 was
there were more
horrendous.
homes available to be sold if people chose to sell them. That's my point, though. It's a pretty dramatic decline.
Well, what's the month's supply? Do you, because I know I have it for the US.
Yeah,
but
I don't have it in front of me. It's going to be, I think it's going to be in the threes, which is low.
That's pretty tight, right?
If you look at if you look at standing inventory, people get all upset about this. It's like that. This is just what the data is showing us. If you look at standing inventory, it's really low. So that's literally just like how many houses are on the market for sale right now, and it's coincides, like every time you go back and you look at every bull market, like the level of inventory that we have right now suggests to me that without the weak demand that we have, if you just had, let's say, a normal amount of demand, you would have double-digit price growth minimum, given where the level of inventory is. Now, again, I think the inventory, I think, and hopefully it begins to sort of increase, and we get a little bit more balance in that market. But that's what's happening. That's what's happening in the GTA as well. Sales are still really weak, but there's also not a lot for people to actually go out and buy. So it's kind of this fake market that it's really hard to say you've got one direction or the other. I mean, people are saying, well, there's multiple offers. Well, there's multiple offers because there's literally nothing for sale. So
we still have to wait for that inventory thing. I mean, you mentioned this a couple of months ago. You're not going to call it whatever it is until we sort of see that spring, early summer inventory come online. I think you've mentioned that a couple of times to us. Right?
Yeah, there's just activities are usually pretty thin in December, January, because like, again, inventory is always typically low. So it's really tough to sort of extrapolate and say, well, based on the last 6 weeks, this is what is going to happen for the rest of the year. So yeah, I think it's way too early to be making any calls, but certainly I can tell you that from a behavioral sentiment perspective, sentiment has improved. But I think that sentiment was overly bearish. It was way like too pessimistic. And I guess as it should be, people were nervous about inflation. Bank of Canada comes out, raises rates 100 basis points at one of their meetings. Like, of course, people were scared. And now that I think they were like, okay, well, he's saying he's going to pause rates and fixed rate mortgages are coming down. Maybe not a lot, but they've come down. So I think that people have a little bit more clarity on what borrowing rates are going to be. I think it's giving them a little bit more confidence to re-enter the market.
Well, it's funny you should say that, because you could almost use that description for the equity market and what we've sort of seen, which is, the pause with sort of some more visibility on what's going on in the interest rates. That sentiment was way, way, way too low, or you can make the case is still quite low and has sort of improved. Anyways, that's sort of, I just think it's funny that you can actually make almost the exact same sort of commentary for the housing market in Canada and what's going on in US equities especially, but also the rest of the world. I mean, it tells you sort of, it really is in some ways quite the speculative asset, Canadian housing.
But I mean, that's the thing though, right? It's like, I mean, Keith mentioned it earlier, which is all these markets, global financial markets, are all like synchronized now, right? It's like all the central banks are more or less moving in tandem. And financial markets are all just predicated on, it's just like this game now that's sort of manipulated by, central bankers, and they all tend to move in the same direction.
Yeah.
So, I mean, two takeaways from me from the conversation we just had. One is the disconnect. Another one is the complacency. And what I mean by disconnect is actually related to the. I know, Rich, you're always saying when I ask a question or say something, you always say, "I was going to say that." You know, I like that. Right?
I do not
appreciate it.
always do that.
Every now and then. But the question you asked Ron was one of that I had as well. So in this case, I was going to say that, but that's referring to the disconnect, because the macro aggregate data for the housing market and everything related to it for Canada, it's just flashing red. You know, it's extreme, as it is for other countries as well. And you know, for everyone listening, it doesn't, because there's a risk, it doesn't mean the risk has to occur. It just means that you have to be aware of the risk. And at certain points in time, the probability of that risk being triggered or ignited, it's a lot higher than what it is at other times. So right now, in our view, the probability is significantly higher than it was in the past. But yet the disconnect here, though, is when you're chatting with the banks and everything else, is that everything is okay. You know, we're just in this normal cyclical downturn. So that's what I mean by the disconnect. And it will get reconciled somehow. Either the aggregate macro numbers will become less aggressive, or they'll soften somehow. Or on the other side of it, the risk actually does get reflected. But I go back to the complacency story, and we've talked about this quite a bit as well. Canada has never experienced a housing or banking crisis, and for that reason, no one is prepared for it. And I know we've been talking about it a lot as well. The population growth and all that is extremely helpful, but again, we need to be aware that if something did happen to trigger job losses or no job growth, in the two main housing centers, looking at Toronto, GTA, and Vancouver, then it's going to be something a bit creepy coming along there. So disconnected complacency are the two main things that came across. Do you want to talk about?
Before you want to go on, Keith, I just want to add one thing, which is not to Ron's obviously experienced and he knows a lot, but I also think mortgage lenders are not leading indicators. I think that's just with respect. I think bank lending is a lagging sort of pro-cyclical indicator. And that's the part where, just because they're not worried about employment now, as you so rightly stated, Keith, doesn't mean that we aren't going to be faced with that prospect very, very, very soon. But maybe we should let's touch on
that, because I think, to Ron's point, okay, we're worried about employment, and that's so obviously is going to depend on the economic outlook and jobs. So we had some reading out of the ISM here, some JOLTS numbers, et cetera. Rich, do you want to quickly walk us through that? We're a little bit short on time here, but give us the high level notes here.
Well, it's my favorite word in the English language is the diffusion index. And the most important diffusion index, I would think, in the world as far as macroeconomic data is the US ISM manufacturing PMI. It's quite the mouthful. We've talked about this a lot for regular listeners. It came in 47.4. So again, above 50 is sort of expansionary territory. Below 50 is contractionary territory. That's sort of them's the rules. The things that I look at obviously are the other, the parts of it. So you can see, new orders is contracting at a faster rate. Production is contracting at a faster rate. Employment growing at a slower rate. I can go on and on. We've talked about it. You can find this online. I think the ISM is the single most important indicator. I think economic indicator. It tracks global activity. The US is one of the largest economies in the world, and it's got its fingers in many pies, as you can imagine. And as it's going down, I think it's to me is very, very, I don't know. It's another flashing red signal as far as global growth. Now, we'll see what happens with the ISM services next week, and but we also contrast that, and that's been negative too, by the way. So it'll be really interesting to see if we can get a second month in a row with the ISM services below 50, and that'll be, I think, the death knell to any talk of contraction as far as the US is concerned. May not be true in Europe, but definitely not the US. We also contrast that with the the employment data. So you were going to mention the JOLTS, Steve. So why don't you talk about that?
Yeah, I mean, everyone always gets confused. The job openings and labor turnover survey. So
I'm the only one who gets confused. I can never remember it.
The from what I understand, there was 11 million job openings.
Yeah.
Was that correct? And so,
Yeah.
and anyways, the rhetoric, I suppose, on financial media and Twitter was, well, the Fed still hasn't cracked the labor market, and so they're going to have to keep going. And it just continues to be resilient. So I don't know how much weight to put into that number, but curious your thoughts.
Well, just another way to think about it is it's almost 2 jobs per unemployed person, which is really kind of incredible. Again, there's still loads of skills mismatches. There's loads of people who left the labor force. You alluded to earlier, a lot of baby boomers who are just cashed up and no need. The equity markets went up. I mean, this is why, quantitative easing is just asinine. It's basically just the handing money from labor to capital. Maybe that's a conversation for a different day, but this is exactly why people like me argue against it. There's also data on the employment front that's come out that's not as good. So there's something called the Challenger layoffs. And so basically it's an index, I believe, or a count of all of the the layoff announcements that companies might have, and they try to aggregate, if Apple is getting rid of this or Walmart getting rid of that, and they and obviously it spikes in recessions, and I think we're at the highest level, I want to say, in 2 or 3. So was it September 2020?
September 2020. Yeah.
And I think it's 104,000 off. I'm doing that off memory, so if I screwed that up, I apologize. But so that's going up a lot. We'll see. A lot of them were centered in tech, and tech's one of the best performing sectors this year. I think, tech's been over hiring for a long, long time, over earning. All of a sudden, people are worried about their earnings and their margin contraction. And one way to help your margins is by laying off a bunch of people, basically, and controlling spending. It's also probably an indictment on their growth outlook, and maybe that's a sort of maybe where I'm getting. It's too much of a tangent for this sort of our constrained time, but it really is interesting to see to contrast those sort of 2 economic indicators. Just for the record, the employment indicator for the ISM manufacturing is above 50, so it's growing but slower.
Keith, how are you squaring all this data? It's like I don't know about you, but it's like I think people can pick out the data points that they want that will suit their narrative. I think anyone, myself included, is guilty of that at times. But how are you looking at this big picture? You get like the JOLTS numbers, but then you get the ISM that's contracting, and then you get this other index that says things aren't so great either. It's like, how are you looking at this? Are you still status quo?
Well, no, because now we always talk about the path, and now we've shifted to the path where tightening by central banks, it seems to be almost over, right? Depending on which one. So let's just take that for face value. And now it's going to shift to, hey, there's no recession. Everyone has said we're having a soft landing. This is unbelievable. This is great. And, we've only had 1 month this year, and equities are doing well. NASDAQ is flying, by the way, not because of earnings, nothing to do with that. It's just with no more rate cuts coming up.
Rate hikes.
That's extremely positive. So it's going to be like a mirrored image what happened with NASDAQ and those related sub-industries and stocks in 22. But now we're going to start coming into is there a recession or not? And right now, the base case is that there's no recession, or it's merely a slowdown. So we'll start to see that shift over the next couple of weeks. And then you're going to see financial markets adjust to it. The risk we have now is that it is not a soft landing. So if you look right now, what's the market forecasting for the Bank of Canada? So by December of this year, so Rich, that's 11 months, so it's 12 minus 1. It's going to be 50 basis points cut. That's what the market is suggesting right now. So, there's lots of studies. So how long does the central bank, after they stop raising rates, how long before they cut? And then the number goes from like 8 to 15 months in that range. So it's interesting. That's what they're saying here now for the Bank of Canada. But this is a finely tuned forecast. It's suggesting that we do have a soft landing. things maybe struggle a little bit and the bank is able to start making little tweaks to policy, I'm going to be incredibly shocked and surprised. And is this a British term for you? Flabbergasted? Is that what they say over there, Rich?
Sure.
No. Yeah, that's another one. That's another one that the Brits say.
It's a new era. Why not?
Yeah, I worked with a bunch of Brits. They're funny guys, right? They're just odd.
They are
odd guys. Yeah. But yeah, that's where we're going next, Steve. It's the whole discussion. Is it a recession or not? If it is a recession, then it's going to have, knock-on effects on, the banking and housing, leveraged economies and countries.
Yeah, that's a great. So I mean, just to kind of start to get wrapping things up here, but so the Bank of England came out as well, just covering the last two central bankers here. So the Bank of England, they raised 50 basis points, and they basically signaled a pause too. Did they not, Rich?
They did. All sort of. I mean, it was kind of garbled what they wrote. I'm looking at the quote right here. Well, the ECB first of all said that there's definitely more to go. And then I think the UK Bank of England, my goodness, said that I think that they haven't paused, but that they're getting to the end of it.
Keith, what did you watch any of the ECB presser, and do you have any takeaways? I know you're fascinated with ECB policy, so I'm curious if there was any takeaways for you there.
Yeah, there was one. It was kind of funny because the Fed presser last week, it got salty for a little bit, right? Back to back questions that the Fed didn't appreciate, and it happened at the ECB today. There was one question that was not appreciated by Lagarde, and effectively, the gentleman who asked the question, he more or less phrased. He said, inflation data is coming down aggressively. Oil is coming off aggressively. The economy is slowing down. Wage growth is slowing. Everything is already happening, yet you're telling us that you have to be aggressive to stop inflation. Yet it's already happening before your rate hikes have even kicked in. So why are you still trying to sound like a hawk? That was basically the question. And that was very. It was greatly appreciated. No, it wasn't. She hated that question. So, but my point is that now these questions, they are being asked. And, the ECB, they basically said, yeah, we're going to do another 50 basis points hike next month. And then she walked it back a bit. And she said, well, we're not saying we're definitely going to do it. We won't do it if obviously the data has changed. But for what it's worth, it seems like they're basically done now next month as well. So again, everything is synchronized, and everyone knows mathematically the numbers are coming off. Oh, one observation I wanted to share with you guys now. This is anecdotal. I'm starting to see labor strikes taking place. So it's happening at some of the universities, different spots in the healthcare sector, and I don't know what wage rate increases they're asking for, but again, it's kind of interesting because with these labor agreements, it's living in the past effectively, right? Like this happened the last year or 2 years. We need to get compensated for that, whereas our economy tries to be more forward looking. So anybody that is in a labor negotiation now, you get a real nice wage increase with it. Say it's 4, 6, 7%, maybe that could happen. You're probably ticking the top of the market, which is. Did
you see the CRA is asking for a 30% wage increase over the next 3 years? That's 10% a year.
Are they really?
Yeah, it was in the news. It was pretty funny.
What's their profit margins like these days? Like, are they growing or?
Well, they are growing. They're definitely growing.
The ironic part is
government
raise taxes
employment
to pay for their wage demands.
Keith, the CRA is definitely growing.
I think the CRA is awesome. They do great stuff. Just to share with everyone, I don't know if Steve will or not, but this was a new format for us today to have someone on. It's not our plan to do it every single week. We will try to introduce people when we think it's appropriate. And we are, we've already talked about it, but we're going to invite leaders from the 3 main political parties in Canada to come on for a conversation, as well as the Finmen and stuff like that. We don't know if they'll come on board or not, because we have Rich with us, but we're going to see what happens here. So let us know how you guys feel about this, if it's worthwhile or not. And we're always seeking to make things better here at the Loonie Hour.
That's a call to action. If you've got any commentary on the interview process, we'd love to hear your feedback. The goal is to really do one interesting guest per month, which we feel is definitely attainable, and we want to keep it Canadian centric, focused, really talking about policy and so, hey, if you're a interesting person, a government official, a central banker, former central banker, and you want to come on the show,
Hockey Hall of Famer,
Wayne Gretzky, you hear this? Send us an email, and we'll coordinate having you on the show. But yeah, as of right now, I think it's a good place to wrap it up. We've got markets again. Everyone's bracing for the soft landing. If central bankers can pull us off, it'll be like Captain Sully there landing on the Hudson. This will be really, really something. So let's see if we can pull it off. And as always, we appreciate you guys' support, and we'll see you next week.